Hello and welcome back to RG Manabat and Company's Insights, where we dissect and discuss significant tax matters that impact you or your organization. My name is Salvador, Country Leader for Indirect Tax Services and Tax Intelligence Solutions Champion. And I'm glad to have you with us again. Now, last time, if you recall, we discussed the salient provisions of RA 12023, also known as the Digital Services Tax Law, which is reshaping how digital services are taxed in the Philippines. Today, we're going even deeper into the operational and compliance aspects of the law by going over the draft implementing rules and regulations, which was circulated by the BIR in early November, if you will recall, for public consultation purposes. And of course, joining me again is the ever insightful LA Robediso. Hello, LA.
Hi.
One of our tax partners and country leader for Global Compliance Management Services and Tax Reimagined. Welcome back, LA.
Thanks, Manny. It's great to be back. The response to our first episode was incredible, and I'm excited to unpack more details today following the release of the draft IRR.
Yes, LA. The practical application is the key focus for this episode. From registration to filing, input VAT claims to exemptions, we've got so much to cover today. So let's get right into it, shall we? Now, for my first question, how do you think the BIR is planning to implement and enforce the Digital Services Tax Law? Let's go over each section of the draft IRR, shall we? Starting with Section 2. LA, the Digital Services Tax Law applies to individuals or juridical entities, whether resident or non resident, that supply or deliver digital services in the Philippines.
That's right, Manny. Inclusion of non resident digital service providers, or DSPs, is the main thrust of the Digital Services Tax Law. By making them accountable, the government ensures a level playing field for local and global players. The draft IRR also specifically provides that the law does not cover the sale, supply, or delivery of physical goods from a foreign territory to a consumer, user, or buyer in the Philippines, as this is considered an importation of goods subject to customs duties and VAT or excise tax and other charges by the Bureau of Customs. This was also highlighted by the BIR during the public consultation it held just last month.
Apparently, Section 2 specifies two types of transactions: the business to business, or so called B2B, and the business to consumer, also known as B2C transactions. Now, LA, do you think you could break these two types of transactions for us?
Sure, in B2B transactions, the buyer is a natural or juridical person engaged in business in the Philippines, while in B2C transactions, the buyer is not engaged in trade or business located in the Philippines.
But why handle B2B and B2C transactions differently?
Well, businesses are already part of the tax system and can act as intermediaries for VAT collection. For consumers, placing that responsibility on DSPs makes sense since they're better equipped to handle the process.
So, if I get it right, the goal is to simplify VAT collection while ensuring compliance. But what happens in case where the DSP is unregistered? Does the law cover that as well?
Yes. In unregistered scenarios, especially with non resident DSPs, the reverse charge mechanism applies, which is defined under Section 3 of the draft IRR.
Hold that thought and let's get into that later. Now, under Section 2, how are DSPs categorized as to compliance? Okay.
DSPs are categorized either as a DSP directly delivering or supplying digital services and or a DSP acting as an online marketplace or e-marketplace on the transactions of non-resident sellers, suppliers that go through its platform. As discussed last episode, the law will apply to an e-marketplace if it controls key aspects of the supply and performs any of the following. First, setting directly or indirectly any of the terms and conditions under which the supply of the digital services is made, or it is involved in the ordering or delivery of digital services, whether directly or indirectly. The draft IRR doesn't seem to have elaborated on what controlling the key aspects of the supply is. So it's possible that this will be contained in a revenue memorandum circular.
I agree, LA. Sometimes the questions of stakeholders, which were not answered during the recent public consultation, are addressed by the BIR through subsequent RMCs. Now, let's go deeper now into Section 3 and 10. No? Under Section 3, which defines the key terms used in the Digital Services Tax Law, this sets the foundation for how the law will be interpreted and enforced, LA. Why are definitions so critical in regulations like this?
It is really critical because definitions establish clarity. The digital economy is vast and diverse, so having precise terms ensures consistency in application. Whether you're a DSP, a non resident platform, or consumer, these definitions determine your obligations under the law.
I guess that's right, LA. Misinterpreting a single term could lead to noncompliance or missed opportunities. Now, let's dive into some of the major definitions. First up, very basic digital services. The law defines this as services supplied over the internet or other electronic networks relying essentially on automation. LA, how broad do you think is this scope?
It's incredibly broad and intentionally so. Digital services include everything from online marketplaces and search engines to cloud computing and streaming. Essentially, if it's delivered online and automated, it qualifies as a digital service.
Yeah, you're right. That's pretty broad. Now, what about the more niche type services? Like, for example, AR tools or cybersecurity platforms. Are these covered as well?
Yes, they are. The definition explicitly mentions IT infrastructure like data storage, web hosting, AI driven business analytics, and cybersecurity services. It even includes digital goods like ebooks, music downloads, and online gaming subscriptions. So the law keeps pace with emerging technologies.
Wow, that's pretty expansive. But there are digital services which are exempt from VAT, right, LA?
That's right, Manny. As discussed last time, the law provided three VAT exempt digital services. First, educational services, which includes online courses, seminars, and training provided by accredited educational institutions or government agencies like DepEd, CHED, and TESDA. Subscription services for educational institutions, which includes platforms offering content exclusively to DepEd, CHED, TESDA, or recognized educational entities. And financial services provided by banks, non bank financial intermediaries, and virtual asset service providers or VASPs registered with the BSP.
It just occurred to me that these exemptions appear to reflect public welfare priorities. Educational and financial services are critical areas where the government may want to reduce cost and encourage access.
Well, this essentially expands the coverage of what are already included under Section 109 of the Tax Code on VAT exempt transactions.
Another good definition we could look at would be digital goods, a subset of digital services. By definition, these are intangible items delivered in digital form, like music, videos, or software. LA, why do you think there is a need to call this out separately?
Well, digital goods often blur the lines between services and products. Highlighting them ensures that they don't slip through the regulatory cracks. For example, ebooks or app downloads must be treated as goods in other contexts, but under the Digital Services Tax Law, they're taxable digital services.
And these would include subscription services, right? Like streaming platforms or cloud storage.
Exactly. Subscription based digital content falls squarely under the term digital goods.
We can now look at another definition, that of gross sales. The law defines this as the total sales revenue derived from supplying digital services. How is this calculated for non-resident DSPs, LA?
Okay. Non resident DSPs must convert all payments to Philippine pesos using either the spot rate from the Bankers Association of the Philippines or BAP or another approved rate. This ensures uniform reporting regardless of where the service originated. The draft IRR provides that the taxpayer may use a different forex rate other than the BAP published rates, e.g., Bangko Sentral ng Pilipinas, Bloomberg, Reuters exchange rates, shall be subject to the following conditions. First, taxpayer must submit to Revenue District Office number 39 a notice stating the 1. Source of the foreign exchange rate used, 2. The reason for using such rates other than BAP published rates, and 3. A statement allowing the BIR to have an access on the day-to-day forex rates used during a BIR audit within 30 days prior to the start of the taxable year. And the source of forex rates used in converting foreign currency denominated transactions, such as URL source, where the forex rates are published or listed, or a summary of the day to day exchange rates to be used for the taxable year, must be available for presentation and submission during a BIR audit.
So LA, the term gross sales includes all transactions, right? Both B2B and B2C?
Under the regulations, yes. For non-resident DSPs, gross sales include both business and consumer transactions. So, for purposes of determining whether a non-resident DSP will be required to register for VAT or not, both its B2B and B2C sales will be considered to see if it breached the 3 million threshold.
Wearing now my second hat as indirect tax services country leader, and based on my conversation with the indirect tax services network, it would appear that this approach differs from how most other countries have implemented their own digital services tax laws, where B2B sales are typically excluded from the calculation of gross sales. Now, let's discuss the reverse charge mechanism, LA. How does this work?
Okay. This mechanism shifts the VAT liability to the buyer. For example, in a B2B transaction, a VAT registered Philippine based company purchasing from an unregistered non resident DSP is required to withhold and remit the VAT directly to the BIR.
So let me get this correctly. It ensures that VAT is collected even if the DSP doesn't comply, right?
Correct, Manu.
Okay, so that's pretty insightful. Now, maybe we can now go to section 4, which outlines several criteria for determining if a digital service is consumed in the Philippines. These include payment information like credit card details, residence information such as billing addresses, access information like internet protocol addresses, and any other reliable indicators of consumer location. Now, how effective are these, LA?
They're quite robust. I believe these data points are widely used globally to pinpoint where a service is consumed. For instance, if a buyer's billing address and IP address both indicate they're in the Philippines, it's clear the service is taxable here.
But what about edge cases like users who travel frequently or use VPNs to mask their location?
Well, those scenarios add complexity, but the law anticipates this. It allows for flexibility by including any other reliable indicators. DSPs must adopt systems that cross reference data points to avoid errors.
Now, this is probably top of mind for many listening to this podcast, but what is the responsibility of the DSP in ensuring compliance here?
DSPs need to implement technology driven solutions to monitor user data accurately while also adhering to data privacy laws. Failing to identify taxable transactions can lead to underreporting and penalties.
Thank you, LA. Now, this brings us to Section 5, which mandates that DSPs have to register with the Bureau of Internal Revenue. This includes both resident DSPs operating locally and non resident DSPs offering services consumed in the Philippines. Now, LA, why is registration such a critical component of this law?
Registration is the gateway to compliance. It formalizes a DSP's presence in the tax system and ensures they're recognized for VAT purposes.
And I suppose for non resident DSPs, this must be new territory for them. They've traditionally operated outside Philippine tax jurisdiction. Why is this shift significant?
It reflects the government's push to capture revenue from the global digital economy. By requiring non resident DSPs to register, the Philippines ensures fair competition between local and global providers while expanding its tax base.
Well said, LA. Now let's go into the requirements needed of DSPs, starting with resident DSPs. No? For DSPs based in the Philippines, registration follows the standard rules under the tax code. But then, what about non-resident DSPs, LA? Section 5 introduces the VAT on Digital Services portal as the primary registration platform for non-resident providers. Now, how does this work, LA?
The VDS portal simplifies the registration process for non resident DSPs. They don't need a local office or representative in the Philippines and just need to provide certain information requested by the BIR. Once registered, they'll receive a TIN and a certificate of registration, enabling them to fulfill their VAT obligations. How user friendly the VDS portal is remains to be seen.
Well, at least they have a simplified method of registration. So that must be a relief for non-resident DSPs. But for example, what if a non-resident DSP wants to appoint a third-party representative in the Philippines?
They can do that too. Non resident DSPs may appoint a third party service provider like KPMG to handle tax filings and record keeping. This isn't mandatory, but it can definitely make compliance much easier.
So it seems there's flexibility for DSPs to manage compliance efficiently. And I suppose the BR will look at that as a no excuse reason for not complying. But what are the consequences of failing to register?
Section 5 is clear. Non-compliance can result in severe penalties. The consequences are significant as discussed last time. For non-resident DSPs, the BIR can request the Department of Information and Communications Technology or DICT to block their services in the Philippines. That means the platform could become inaccessible to Filipino users or users located in the Philippines.
Well, that's indeed a very strong enforcement tool, LA. Now, are there additional penalties beyond service suspension?
Oh, yes. Non-compliance could lead to fines, surcharges, and even inclusion in the BR's Run After Tax Evaders or RATE program. The law takes a firm stance to ensure compliance.
And I suppose to avoid penalties, one must have to be mindful of compliance. So let's go into that. Section 6 lays out the rules for filing tax returns, remitting VAT, and making payments. Now, LA, what are the key takeaways here?
So here are the key takeaways. Under the draft IRR, the obligation of a DSP shall depend on whether it is a resident or a non-resident and whether it is VAT registered or not. Resident VAT registered DSPs shall file the VAT return and pay the VAT due thereon following policies and procedures under the tax code and other existing relevant laws, rules, and regulations. However, if the resident VAT registered DSP is classified as an e-marketplace with non-resident participating merchant seller, it shall also be liable for 1. Electronically filing the required remittance return, and 2. Withhold and remit the 12% VAT due on the gross sales received by its non-resident participating merchant seller to the sale of digital services. For non-resident VAT registered DSPs, their obligations will depend on whether the transaction is B2B or B2C. In B2B transactions, the persons engaged in business shall be liable for 1. Electronically filing the required remittance return, and 2. Withholding and remitting the 12% VAT due on its purchase of digital services. The VAT withheld shall be considered input VAT or cost or expense as the case may be on the part of the withholding consumer or user. In B2C transactions, non-resident VAT registered DSPs shall be directly liable for electronically filing the VAT return and paying the VAT due thereon through simplified pay-only regime in the VDS portal based on its gross sales related to the sale of digital services. They may choose to pay the VAT on a monthly or quarterly basis. However, if they choose to file the return and pay on a monthly basis, they are still required to file the quarterly tax return and pay the corresponding VAT liabilities. And if the non-resident DSP is classified as an e-marketplace, it shall be liable for 1. Electronically filing the VAT return, and 2. Paying the 12% VAT due thereon based on the gross sales received by its non-resident participating merchant seller related to the sale of digital services, provided that the conditions discussed earlier about controlling key aspects of the transaction and performing certain acts are present.
If memory serves me right, LA, the draft regulations also state that the electronic payments or remittances shall be in Philippine pesos. A non-resident DSP may open bank accounts in the Philippines through its appointed third-party service provider for purposes of payment or remittance of VAT.
Correct, Manny.
So the question now is, how will non-resident DSPs know if their customers are doing business or not?
Well, the draft IRR provides that the DSPs may rely on the documents submitted by its contracting party and shall be absolved from any tax liability absent any fraud or negligence. So, in cases where a DSP acting in good faith and having made reasonable efforts to obtain the appropriate evidence is unable to establish the status of its consumer, it shall be presumed that the consumer is not engaged in business, in which case the DSP shall be obliged to file the tax return and pay the tax due. Late filing and payment will be subject to interest, surcharge, and penalties.
That seems pretty clear. But in case of doubt, would it be safer for the non-resident DSP to presume that the customer is not engaged in business?
That's right.
Okay, so we've gone over resident and non-resident VAT registered DSPs. Now, how about the unregistered non-resident PSPs?
For B2B transactions, the customer will be liable for electronically filing the required remittance return and withholding and remitting the VAT due. But for B2C transactions, it appears that these won't be subject to VAT, as my initial understanding is that the unregistered non-resident DSPs are not under the VDS system of the BIR. I think we need more clarity from the BIR on this.
I do agree with your observation, LA. Now we can go to section 7, which focuses on claiming input VAT, a very important section of the draft regulations. Now, for VAT registered DSPs, this can significantly reduce their tax liabilities, right, LA? So, what does this mean for DSPs?
Well, claiming input VAT allows VAT registered DSPs to deduct the VAT they've paid on goods and services directly related to their operations.
But non resident DSPs can claim input VAT, right?
Correct. Non-resident DSPs operating without a physical presence in the Philippines cannot claim input VAT. However, if they register as a resident DSP, they become eligible for this benefit. But it's important to highlight that opting to have a physical presence in the Philippines would essentially mean being subject to other taxes like income tax, expanded withholding tax and compensation, and other internal revenue taxes in addition to VAT.
So, it would seem that non resident DSPs need to really have a grasp of the Philippine tax landscape before deciding to establish a physical presence here. And of course, KPMG is here to provide that sort of guidance, especially with the compliance requirements, which includes our next section. Very important, issuing invoices.
That's absolutely right, Manny. Thankfully, non-resident DSPs have simplified requirements for invoicing compared to invoices issued by Philippine companies. The invoices to be issued by non-resident DSPs should at least include the following information: transaction date, reference number, consumer identification, description of the transaction, and total VAT inclusive amount. The invoices don't need to be BIR registered, but they must be in English or include an English translation.
Now let's talk about accounting requirements, LA. What's expected of non-resident VAT registered DSPs here?
Non-resident VAT registered DSPs don't need to maintain accounting records or subsidiary journals. However, in case of a post audit or verification by the BIR, the non resident DSP would need to explain any discrepancy.
But how will the BIR conduct post-audit and verification on non-resident DSPs?
The draft IRR provides that the BIR may conduct verification from third party sources on whether non resident DSPs are declaring their gross sales and that of their customers for VAT purposes. The BIR shall inform the non resident DSP of any discrepancy discovered and provide them an opportunity to immediately settle it. Otherwise, their digital services may be blocked, in addition to be subject to administrative and criminal sanctions.
Now let's go to a couple of provisions that I think should be given a lot importance, which are the transitory provisions of the regulations. Now, Section 14 provides a 60-day registration period for non-resident DSPs once the regulations take effect. Now, Ellie, do you think this timeline is feasible?
It's a tight window, especially for smaller DSPs unfamiliar with Philippine tax laws. However, for larger platforms with established compliance teams, they may be able to meet the deadline. Though during the public consultation with the BIR, some attendees were asking if the deadline can be extended to any time before the end of the 120-day period from the effectivity of the regulations, which is when non resident DSPs will become subject to that. The BIR just said they'll look into it, so we'll have to see.
So the inevitable question, Ellie, what happens if the non-resident DSP misses the deadline?
They'll still need to register, but they face penalties for late compliance. The sooner they act, the less risk they face.
You know, my wish is that the transitory period under the final version of this implementing rules and regulations could give stakeholders enough time to adjust and comply. You know, the issuance of rules and regulations will provide a definitive start date for compliance. DSP should use this time to register, update their systems, ensure that they're ready to meet the law's requirement.
Exactly, Manny.
All right, LA, we've covered most of the provisions of the regulations. Now, before you wrap up, what steps do you think DSPs and businesses should take to navigate through this new law and its implementing rules and regulations?
DSPs should prepare early, register promptly, and ensure their systems can handle VAT reporting. Good record keeping is also important as this will help with audits and avoiding penalties. Stay on top of filing schedules and transitory provisions to avoid late penalties. Engage experts for non resident DSPs. Working with local tax consultants or third party representatives can simplify compliance. And lastly, stay informed. Keep track of updates from the BIR to ensure you're always compliant with the latest regulations.
Again, as usual, well said, LA, and thank you for sharing your insights. And thank you, our dear viewers and listeners, for tuning in. Now, if you have any questions about RA 12023, or if you need clarification on compliance, don't hesitate to reach out. Until next time, I'm Manny Salvador of RG Manabat and Company Insights, helping you and your organization navigate the future of digital taxation with confidence.